My name is Lee Abel, and I have been an independent long-term care insurance advisor since 1996. So I've seen a lot of changes in the industry, and I have a lot of information about aging in America and some options that we have for it.
So before we get started, we have two polling questions for you to quickly help us with. So the first one is, do you know anyone who has needed care from others for an extended period of time? These are all anonymous, by the way. And the second question is, do you have long-term care insurance in place now?
So basically, it looks like about 70% of people on the Zoom or call have had that experience of knowing someone who's needed care, and about, looks like 43% have long-term care insurance and the others do not. So that's a great starting point for me. So as I was saying, I've been doing this for a very long time, and I've actually been speaking at the California Pacific Medical Center since 1996 as well. Things have changed though. So I want to discuss the basics of it. We're here to talk about long-term care and different ways to finance it, in particular insurance. So what you need to think about first is the startling statistic that 70% of people turning age 65 can expect to need some type of long-term care in their lifetime. I didn't make up this statistic. It's through the U.S. Department of Health and Human Services. And basically the reason for this is kind of twofold. One is that we're living a lot longer and a lot healthier. So we just get old. It's really kind of as easy as that. The medication is keeping us alive and we're living longer. So because of that, and also the second reason is that families that used to take care of loved ones for long-term care, for the most part, that's not as popular as it used to be. So it's kind of a crisis in our system. Why is it not going to the next slide? Here we go. And also keep in mind that women are especially at risk for either needing or being the providers of long-term care. So long-term care is actually more of a woman's issue than a man's issue, at least traditionally, because traditionally women have taken care of men, been younger than their partners, and been the ones that are there for them. And then women are alone, often without a significant partner, and sometimes financially insecure at that time. So women are sort of at double jeopardy for needing long-term care. Women also have longer life expectancy, which means that they are going to live for a longer period of time being elderly and just starting to need help with the daily activities of living or cognitive impairment as it happens. So let's talk about what long-term care actually means when I'm mentioning it. So long-term care is primarily what we call custodial care, which is non-medical care. We're not so much talking about what happens when you have a stroke and you're in the hospital. That's going to be taken care of by your regular health insurance. But if you had a stroke and after that, you couldn't live independently anymore, whether you're at home or you're in a facility, that would be long-term care. So there's three main places that people go to when they need long-term care. The first one, the screen that you see, that's home care. And care at home is going to be primarily custodial care. So again, it's primarily not medical care. If you were to have a nurse around the clock at home, you would have to be extremely wealthy to be able to afford that. So if you're at home and you need help, you might not want the family members to be the ones doing 100% of it. and you were to go through an agency to receive that care, the agency's rates these days in the San Francisco area are about $30 to $50 an hour. If you were to need someone around the clock, you're talking more about $22,000. I've even seen it as high as $25,000 a month for 24/7 care. It's actually become more expensive recently because a couple of years ago, a bill was passed that made a requirement for overtime if you're over 8 hours. So in your home, you're going to be able to receive both custodial and skilled care, but the vast majority of people will receive custodial care. But the great thing is, of course, you're at home and you can also have somebody coming in who takes care of your home, shopping, cooking, things like that. And also, I don't know how many of you are familiar with adult day care and hospice care, but that would all be considered part of home care. So adult day care would be when you go out, if any of you have seen the mysterious vans that are taking seniors someplace or another. They're probably taking them to a daycare center like On Lock or a neighborhood daycare center where they might have a meal, have activities, maybe some physical exercise and things like that. That's adult daycare. And then hospice care is when your doctor says that you have, 60, 90, 100 days left to live, and they're not trying to treat the condition. They're just giving you palliative care to keep you comfortable receiving that in your home. That would be hospice care. So one of the things that you want to be thinking about is, where is it that you want to age? You want to be thinking about these things before you actually need this type of care. One of the nice things about working with people on long-term care insurance is that we do kind of discuss what their ideal place would be to receive care, and then try and design a plan that will work for you in a situation like that. So if you do decide that you are like most people I speak with and you want to stay home, you need to consider where that home is going to be, if it has stairs, if it's going to need to be remodeled, if the shower needs, to be changed. My mom turned 92 yesterday. She's completely mobile, drives and all of that. But because of COVID, she stopped going to the gym. And it turned out one of her main things she loved about the gym was the walk-in shower, because she never used her bath shower at home. So now that she's not going to the gym and has decided maybe she'll never go to the gym again, we're trying to figure out what we're going to do to create a walk-in shower for her so she can remain independently in her home. So you have to think about your home situation. And then you need to also think about who is going to provide that type of care for you. Do you have a family member who is set up to do it, who's strong and healthy and doesn't have to work and psychologically comfortable and can handle that? Or is it going to be a burden on that family member or friend? Do you want to hire someone? Where do you want to hire someone? And if you hire someone, where's the money going to come from to pay for it? We're going to talk more about the different ways that you would pay for long-term care. But just know that even if you're a relatively poor person, that Medi-Cal is still probably not going to cover that much of your care that you might receive in your home. So the other options are to go to a facility, and there's roughly two types of facilities. One of them is a skilled nursing facility we'll talk about in a minute, so worst case scenario type situation. But the other one we're going to call residential care facility. Under that heading, though, there's multiple types of residential care facilities. We're probably the most familiar with an assisted living facility, but there's also Alzheimer's or memory facilities. There's board and care facilities. There's continuing care facilities. There's lots of different types of facilities where you would either go there because you need care now, or you would go there, age in place, and care would be provided on site. So we can talk about those a little bit more. And after this section where we just talk about where you receive care and the cost of care and that, I am going to open up if anybody has any questions about this first part. So if you are in a residential care facility, you would have the option to receive 24/7 custodial care. Again, remember, custodial care is help with your daily activities like bathing, dressing, toileting, things like that, getting to and from the dining hall, as well as help with cueing you, keeping you on track if you have cognitive impairment like Alzheimer's, senility, things like that. A residential care facility in general, there's going to be exceptions, but in general, it doesn't provide skilled care. In general, there isn't a nurse there. They will have procedures if you need a nurse, procedures for getting a nurse quickly, but usually there is no nurse there. But they can be very homey. So you move into a place like this and you're not so isolated. I would love it if my mom would move into a place like this, but she doesn't want to be around a bunch of old people. So she's in her own place, aging alone. She still drives, so she still runs around and sees her friends. In a residential care facility, the fee for the facility, you note there, which looks very wide, $4,500 to $1,400 a month, it's because there's different types of facilities. So if you're in a board and care facility, which is a small type of place, it's almost like a home that maybe has a few beds, you're going to pay one fee and it's going to cover room and board and everything else that you need. But on the other hand, if you're in a expensive, top of the line facility, you're going to pay one fee for your room and board, and you're going to pay a second fee per month for how much care that you need. So it can easily get up to $14,000 or more a month. But they will all provide room and board. They'll all provide housekeeping. And usually that's all part of the package that you take out. Of course, you're going to get your medications there, which is as much as you're going to get in terms of medical attention, usually. And then the great thing, again, is that there's activities, but you do have your privacy. Some of the units, if let's say that you move into an assisted living facility when you're still independent, then you would have your own unit. It would have a little kitchenette, but there would also be a dining room area. And you would probably have your choice of meal plans, but have to take a certain number, whether it's 1 or 2 a day in the dining area. And then they have a lot of socializing that you can do. So it could be a safer place and a less lonely place for people to move into. And I encourage all of my policyholders, as they're aging, to at least go visit 1 or 2, take a look, see if that could be something they'd like to do, because they really can be a great place, very supportive for you. And if you were to move into a place like that before you need care, then you can age in place. Medi-Cal is not accepted in residential care facilities. Medi-Cal, again, is the low income. And the reason it's not accepted is because Medi-Cal only relates to skilled nursing care. So they just do not cover residential care facilities at all. The other type of facility is called a SNF, or a skilled nursing facility. They can range from $10,000 to $24,000 a month. Of course, that's going to depend on where you are, the type of facility. You have a single room, you have a shared room, shared bathroom. How was that set up? But a skilled nursing facility does provide 24/7 of both skilled and custodial care, along with the meals and medication and things like that. Most people go to a skilled nursing facility when they're released from the hospital after they've had an event, and they go to that skilled nursing facility to recuperate. And the other group of people that are in skilled nursing facilities would be people who do financially qualify for Medi-Cal, and that's a place that they have found to be at. I don't know how many of you are familiar with Laguna Honda Hospital, but it is probably the biggest, certainly the biggest one in our area that accepts Medi-Cal people. And also because Laguna Honda used to be one of the top rated facilities, you could also go in there privately. When I started doing this quite a few years ago, Laguna Honda, if you went into under private pay, was one of the most expensive places you could go to. Not sure what it costs now. So before we go on, I'd like to know if anyone has any questions regarding what exactly is long-term care, what does it cost, and where do you get it? Okay, I don't see any hands, so I'm going to continue on. Oh, a hand. Yay.
I'm just kind of curious. Hi there, how are you?
I'm good. Good to see you.
Yeah, I was wondering, these numbers are mainly for the Bay Area, San Francisco
Yes.
Bay Area? Okay.
Yes. Now, there are ways that you can check in other areas. There are at least 2 or 3 companies out there that offer or have offered long-term care insurance that put together a yearly calculator. And I can shoot links over when they're sending out the slides and show you the link to that. The problem with some of those, with all of them, is that I feel that the rates that they show for the Bay Area are way too low, just way too low. I don't know where they're getting these from. But the good part about it is, if you're thinking about moving to another area, or you just want to compare what it is somewhere else, the comparison works pretty well. So if you saw that whatever you're looking at was, say, 10,000 in San Francisco, but it was 6,000 in Idaho, then you have a pretty good idea that the cost of care is probably about 40% less in Idaho, even if the rates aren't exactly right. And the other thing about that calculator is that there'll be a section that involves home care, but the fine print, which most people don't even read, says 40 or 44 hours a week. Well, you know, that's not very much. That's 8 hours a day, and that only really works if somebody just needs a little help or has some child, spouse, significant other that's coming in at night and coming in on the weekends. So if you're thinking, you know, I don't have that, it's possible I would live at home and just want to live in 24/7, you would need to multiply that by 3. Okay. While I'm here, let me also extrapolate on something else for home care. I believe everyone on this call lives in California. And California is the only state that passed a particular law, it's a state law, that says that if you have long-term care insurance by state law, they cannot require you to get that care from a licensed agency. You can also get it from an independent care provider who's got appropriate skills, as long as they're not a family member. So what does that mean to you? Well, I'm working with a woman in, I want to say Arizona. I have it wrong, but it doesn't really matter. It's in another state. And she cannot get an independent caregiver that would reimburse her in that state. I mean, it just won't work. She'll have to go through an agency. Now, a lot of people want to go through an agency anyway, because there's oversight with an agency. More oversight than there might be with your friend use this person and think she's great, so she'll come to your house. But anyway, I just want to pass that on. So when you're looking at those numbers in a guide for how expensive care is, or you're even just looking at my numbers, which by the way are taken straight off of, my numbers are taken straight off of rate sheets for home healthcare agencies in our area. But $30 to $50 an hour, you could get care for significantly less than that if you work it out with somebody. So it's just an option that you have. Any other questions, or was that clear? Okay. So what's really important for us is to know how we're going to pay for future care. You don't want to wait until you actually need the care, because at that point, a lot of your options disappear. First of all, obviously you can't get long-term care insurance when you start to need long-term care insurance. That's completely out. But it's also kind of late for starting to move around your finances and trying to figure that out. And oftentimes now the burden is on somebody else and not really you. So one of the things I would encourage you all to do is make sure that your financial plan specifically addresses how you're going to finance long-term care. You know, you hope you won't need it, but we know the statistic that you'll need at least some is pretty high. So it's better to just plan for it. I'm not saying to get insurance, but I am saying to understand where the cash flow is going to come from. So we know that the cost of care is very expensive. We know that it can actually affect a lot of things. So the first thing that will usually happen when somebody needs long-term care is they're going to take it out of their income. So do you have enough income to pay for long-term care as well as to pay for your normal expenses? So let's say you decide that you just want to stay home and you're just going to hire a caregiver to come in. That's great. However, you still have all of your same expenses for being at home. So you have to put that into the equation. If you go into, let's say, a facility, it could be part of your plan that, okay, I'd move to a facility, and then between whatever it is, between your IRA, your whatever you might sell or liquidate, that and the rent that you might get from your house, now you'll have enough to pay for it. So these are all just things I would just encourage you all to consider how you would pay for it. If you don't have significant cash flow, then you're going to have to start to liquidate at least one asset. And so be keeping in mind, what asset would you liquidate? And also you want to consider, would there be a penalty on liquidating that? And would there be taxes on liquidating that? And, you know, in terms of investment opportunities that you're going to lose. But when you need care, you're just going to have to get the money from somewhere. And who's going to help you make these arrangements at the time that you need care? So what I would also encourage all of you to have a power of attorney. If you have a power of attorney and you haven't looked at it for a very long time, I would encourage you to take it out and dust it off and take a look at it and see if that's still the person that you want to have. You want to give that person a roadmap. You want that person to have some idea of where you want to receive care. Do you want to stay home, a facility? You know, it's pretty much granted you don't want to go to a nursing home. And so you're really talking about, do you want to stay home or would you rather go to a facility? And you should be talking about that and getting that. I can't really tell how everyone's age group is, and it's not that important, but I would just say that certainly for those of you who are already into your 70s and on, it's important. You have to get this. Although when I say get this, I don't mean the insurance. I mean, you have to have some arrangement, some communication with your loved ones about what you want to do. My youngest client was in his 30s at the time that he actually needed long-term care. And he just died recently. He had Huntington's disease. And he actually started to show symptoms just a few years after he took out the insurance with me. So he spent about 15 years in a facility. It was not pretty. But he had the insurance, so he didn't have to go through his kids, all of their money, that sort of thing. So again, it's important to protect your if it's important for you to protect your assets, think about it. Is it important? Do you have a spouse? Do you want to make sure that the spouse is taken care of and they're not going through their assets? Do you need to leave money for kids, for heirs, for other entities? So let's consider in more detail options for financing care. The first thing that people think about is health insurance. Well, I have health insurance. Won't my health insurance cover long-term care? It does not. Whether you have regular health insurance because you're under 65 or you have Medicare and a supplement because you're over 65, it does not cover long-term care. So what it covers is the first 100 days of skilled nursing care if you need medical attention and your condition is improving. So if we go back to the person who had the stroke, they had the stroke, they're in the hospital, their Medicare, their health insurance, whatever, is paying for it. They need to leave the hospital now. You know, they don't keep you there for too long. So they're get placed into a skilled nursing facility, but they still need a certain amount of medical attention. The Medicare and supplement, or your private insurance, will pick up after whatever your deductible might be. Some people have deductibles, some don't. Will pick up the remainder of the first 100 days of skilled nursing care. Now, what if after day 35, the doctor says, there's really nothing more we can do for you medically, but you'll never be able to walk again, and you can stay in the skilled nursing facility, or you can go to another facility or go home. At that point, your health insurance, your Medicare and supplement will stop reimbursing you for that care, even though it hasn't been 100 days. The reason why is because you don't need skilled nursing care anymore. You're not receiving skilled nursing care. So just keep that in mind. So we are fortunate. We have health insurance, we have Medicare, we have supplements. It does have a piece to play in this puzzle, but it's a very small piece, and it's after a skilled type event when you had needed skilled care. Okay. Another option is to just do nothing and self-insure, but we've already talked about that, and probably if you were dead set on that option, you might not be on this call. So the next thing is to qualify for Medi-Cal. So Medi-Cal is California's name for it, and it's called Medicaid in the rest of the country, and it is for low-income, low-asset people. If you're a single person, it's quite small. You can only have a couple $1,000s in assets. You can have a home. The home is protected. If you're married, you can have significantly more than that because you have a spouse. But the key with Medi-Cal, and I have a slight issue with Medi-Cal planners that are attorneys that put plans together for how people can spend, shield, transfer their assets in order to be prepared to jump on Medi-Cal when they need it. And the reason I have a little trouble with that is because your options are limited on Medi-Cal. They're really quite limited. You can go to a skilled nursing facility on Medi-Cal, but I mean, how many of you out there, if you needed help bathing and dressing and going to the toilet, would really want to go live in a skilled nursing facility? I'm sure you'd rather stay home with the appropriate amount of care at home or be in a nice facility. Well, Medi-Cal will cover a little bit of home care, but certainly nothing like a 24/7. And it won't cover you at all in a residential care, assisted living, Alzheimer type facility. So it is a stopgap thing. That's why you don't see, a lot of people can get on Medi-Cal unless they have, some mental situations going on. You don't see a lot of them lying on the street because they can be put into a facility. They qualify for Medi-Cal, okay? Another option on the kind of exact opposite of this would be to buy into a continuing care retirement community. It can also be called a life care facility. And you might want to think of, like, say, the Towers or the Sequoias. Those are a couple of pretty common names here in San Francisco. And with a place like that, they tend to be for financially secure people who would like to live in a community, in a very nice, for the most part, they're usually upscale communities, and you buy a unit there. Now, in order to buy a unit, there is usually an age ceiling. These ceilings change, so I'm not going to tell you exactly what they are, but most of them would tend to be in your 80s. usually your early 80s, and you have to be healthy. There's differences of health though. So if you walk to the front door and you're senile, they're not going to accept you. If you came to the front door in a wheelchair, they're not going to accept you. But you might have a health issue where you really don't need any help at all right now, and they may very well accept you. And you have to be wealthy. You have to be financially comfortable. To buy into a unit like that, you might be paying $100,000, a couple $100,000 or more. Can be very expensive to get a really nice unit. And then there'll be options you have in terms of what's going to happen to this when I die. When they first started and a person died, there was no value to their family. In other words, they lost that equity. So they bought $200,000 unit and then they passed away, whether or not they needed care. And there's nothing that goes to the family. But then they very quickly changed that up. So there's other options where you pay certain amounts to come in, and then you have certain opportunities for how much your family gets back out of it. But then the other thing that you need to know is that besides buying into the community, then you do have a monthly fee. And the monthly fee will be adjusted for inflation on an annual basis. Now that monthly fee is going to include things like your meals and your laundry service and things like that, but it also provides for care. And it also provides for as much care as you need. So that's the beauty of buying into a continuing care retirement community, is you have built-in care. You've joined it when you're healthy. They usually have a bottom number too, unless you're a spouse. You know, like, I'm going to go out on a limb here. I don't know exactly what it is, but let's say 55, that you can't buy in until you're at least that age. But if you were, say, you know, a 75-year-old with a 50-year-old spouse, then they could come in with you. Now, most continuing care retirement communities will also have skilled nursing on the premises. They'll have assisted living that comes into your unit, or some of them require that when you need assisted living, you need to go to the assisted living wing. This is something, if you're interested in this type of facility, when you go looking, you need to ask this question. It's one of the most important questions. If you don't have long-term care insurance and you're depending on the facility, you need to find out, do I get to stay in my unit and the care comes into my unit, or at that time, am I being moved? A lot of times you're being moved, and a lot of people don't like that. I had a client once who was a client of mine for a number of years and then moved over to the facility that's next to Japan Center. I'm blanking on the name. Some of you probably know what it is. And then she had issues and she needed care very shortly after moving in, and it came time to renew her insurance and she was going to drop it. The person at the facility who managed it told her not to drop it, because if she drops it, when she gets to the point where she needs more care, she would have to leave her unit. And if she was unhappy with that, she should keep the insurance and end up getting the care in her unit, which is what she did. So just a word to the wise, you want to check on that. I would also highly recommend, and again, this is beyond financing care, but highly recommend that you look at other types of facilities way before then. But in terms of financing care, one way of financing care is just to buy in with this continuing care retirement community. Maybe you sell your house, you got a bundle of money for it, you buy a nice unit in a facility, you have enough cash flow to pay the fees every month, you're set. And that's a really good option for people. So keep that in mind. But again, you don't want to wait until the handwriting is on the wall, because then you're not going to be in a situation to buy into a facility. So another option that you have is to depend on your family, friends, and others. And I probably don't need to spend a lot of time on this, other than to say that it's really a given fact out there that if you have a family member taking care of you for very long periods of time, it can hurt them financially, physically, and emotionally. My father needed care for 3 years before he passed away. He was adamant at the time that he took out long-term care insurance that he didn't want a plan that covered home care. At that time, that was something that you could do. I tried to get him to get a comprehensive plan that covered home care. He said no. His wife was 27 years younger than him. And, you know, they swore up and down she was going to take care of them. And basically, after he died, my stepmother, she was never able to work again. She went into a severe depression and died a few years later because she was just worn out, just completely worn out. She told me when he died that she hadn't given him a bath in like weeks. And, you know, it just happens. It sounds terrible, but that kind of stuff happens because it's really stressful to take care of somebody. So the other option then is to have long-term care insurance. Going back to the continuing care retirement community, I have had a few of my policyholders who weren't sure if and when they would move into a continuing care retirement community. They liked the idea, but they weren't ready to do it yet. Bought the insurance so they would have something in place if they ended up not being able to get into the community when they were ready or something happened to them. And a couple of them actually did end up canceling the coverage when they did move into a facility many years later. Any questions about that section? Okay. So some basics of long-term care insurance and getting it and that sort of thing is that it's not super easy to get, and it's harder as you get older. Not everyone can qualify it based on their age and based on their health. And premiums can also be uncomfortable for people, especially as they get older, because they are expensive. So if you are low income, low assets, and what I mean by that, at least in our area, is if you have less than a couple $100,000 in assets, not including your home, you need to make sure that you're really comfortable with the premiums. With some plans, premiums can increase. With others, they can't, and I'm going to go into that shortly. But just keep that in mind. But if you're close to qualifying for Medi-Cal, in other words, let's say you're paying really minimal rent in a small studio or a one-bedroom place where there really wouldn't be space for someone to come and live with you 24/7 and take care of you, and you really don't have much of anything in the way of savings, and you're living off of your Social Security or a small pension, long-term care insurance would not more than likely be appropriate for you. You're probably looking at that you would qualify for Medi-Cal pretty soon. And I talk to people all the time about Medi-Cal. People call me and they're interested to find out about it. And I do ask a few questions about their finances. And in some cases I'll say, you know, it's just not a good option for you because how would you pay for the premiums? And if you could pay for the premiums now, maybe just scrape by paying for them, that's not a good plan for the future. You never want to be in a position where you're insurance poor. So there's two types of long-term care insurance plans. There is a traditional and there is a hybrid type of plan. And they have different features, and there isn't a cookie cutter solution. So it's really what is going to be the most appropriate for you. So you need to really tailor a plan that meets your needs. So let's talk about what that would mean. Actually, before we talk about what that would mean, let me explain how you get benefits from your policy. Because now you took out a policy, you put a bunch of money into it. When do I get money out of it? So most policies are reimbursement plans. So basically you're going to pay the premiums. You're going to pay your caregivers or pay the facilities. You're going to submit the payment to the insurance company. Once a month, you're going to get a check. Now, it can be possible with insurance companies to go directly with the home health care agency or with the facility, but in general, they're still considered reimbursement plans. And there'll be some sort of a deductible first with most plans. They call it in this industry an elimination period. For those of you who have plans right now, you'll see that usually is called an elimination period. And that means what is the number of days that you would have to pay out of pocket that you won't be reimbursed for before your plan starts. And it's probably anywhere from 0 for home care to 180 for facility care. It varies quite a bit. And that's usually features that you can design for what is good for you as well. So in order to actually qualify to receive the benefits, of course, you're going to file a claim, but they're going to look and see, why do you need the help? It's one of two reasons, and often people need both. The first is you have severe cognitive impairment. So that's Alzheimer's, dementia, senility, whatever you want to call it. And it's in your doctor's medical records that you have this impairment, and that it's unsafe for you to live alone. And over 50% of claims have that issue in it. If not 100% that's the only issue, at least it's a part of other issues that exist out there. It's very striking, again, because people are living longer. So we're kept alive, but our minds start to go. And number 2 is that you need help with at least 2 activities of daily living. And your doctor says that you're going to need that help for at least 90 days. So the activities of daily living are standard. They're bathing, dressing, toileting, continence, transferring, and eating. For some of you who have a long-term care insurance plan, you might have 7 instead of 6 daily activities. You might have something called ambulating. You also might be required to need help with 3 of them in certain situations, like a skilled nursing facility. But the way that it is today with the plans today, this is how it's set up. So in terms of what does that actually mean? It means that you're probably going to need help with getting out of the bathtub and not falling. That's usually the first thing people need help with. And think about it like this. When you're an infant, the first thing that you learn to do is shovel food into your mouth. That's eating. And the last thing that you learn to do is bathe yourself. Well, when you're on the opposite side of the aging platform, it's the exact opposite of that. So the first thing that you need help with is bathing. The last thing is the eating, which is just shuffling food into your mouth. So people usually need help with bathing, and probably toileting is usually the first 2 things. Toileting also means getting to and from the toilet, on and off the toilet. Dressing follows pretty quickly too. Continence would be like diapering, and transferring is getting, say, from a bed to a wheelchair, things like that. If you have mobility issues, which are huge as people age, frailty and all of that, bathing, toileting, transferring, all have to do with mobility. Okay, so if you have that, and then the doctor has to say it's expected you'll need it for at least 90 days. So if, for example, you got into a small fender bender and you were on crutches for a month, you wouldn't be filing a long-term care claim, okay? So going back to the types of long-term care insurance, 2 main types. One I'll call traditional, and the other one I'll call a hybrid. A traditional plan is one that is basically a use it or lose it type of plan. Think of it in the same way that you think about your health insurance, your car insurance, your home insurance, or your term life insurance. If you don't use the benefits, if bad things don't happen to you, you get nothing out of it. I mean, you get the unused portion of that year's premium in most cases, but that's it. So a traditional long-term care insurance is the same way. It's a use it or lose it. There isn't a cash value. If you die, there isn't a death benefit with most plans. It's unusual for a plan to have one. And also rates can increase. So you might start and your plan is, say, $4,000 a year for the premium. But in 15 years, the company may raise it. They can only raise it if they can show good reason for the Department of Insurance in any state that they're in. And then they can only raise it the amount that the Department of Insurance allows them to. But they can raise it, and they can raise it more than once. So it's something to keep in mind. However, premiums might be tax deductible. For those of you that are working, there is a tax deductibility for long-term care insurance for self-employed people, for some corporations, and if you have medical expenses and you go over that magic number of deductibility, you can put the premiums in there as well. So that's a traditional plan. Then there's also the hybrid long-term care life or long-term care annuity type of plan. This plan will tend to be much more expensive than the traditional plan, but it does have some great options. If you're in a couple and you both want to just have unlimited benefits, you don't see the point of taking out long-term care insurance just to have a really short amount of benefits, then you could take out together one plan that will never run out of benefits over time. So that's an option. If you hate the idea of taking out insurance and you don't need it and you get nothing back, the hybrids would provide a death benefit for you or your annuity forwarded to somebody else. So that's a really nice feature as well. The benefits, whether they're long-term care or your death benefit, are tax-free. Same as with the traditional. The benefits are always going to be tax-free. But a big one is that rates cannot increase. So it's something to keep in mind. It is less likely the premiums are tax deductible. With some plans, they are just not tax deductible at all. With other hybrid plans, a hybrid life plan, where the premiums are broken down into two sections, one for life insurance, one for the long-term care, then the same applies for the long-term care portion on tax deductibility. Also, these plans have a possible cash value. So you could take it out, maybe you have it in place for 15 years, then you decide to move into that other type of facility. You cancel it and you get your cash value out of it. Okay. So basically, my little thing down the bottom is just a reminder that, like your life and fire insurance, it's always too early to get a policy until it isn't, and then it's too late. So it's a good time to think about how you want to do it. In terms of how to finance the care, in terms of the different ways to consider, how can I finance this premium? Really, where's the money going to come from for the premium? So health savings accounts, you can utilize money in there. You can deduct it as a medical expense if you have enough. You can do a 1035 tax-free exchange from an existing annuity to an annuity long-term care plan or a traditional long-term care plan. You can do a 1035 exchange from life insurance to life insurance long-term care plan or traditional long-term care plan. And a business may be able to deduct the expense. Also, business does not have to offer it to all. The eligible premium limits for 2020 to deduct either from your health savings account or because you're self-employed, I'm showing you here on the screen. So if you're between the age of 61 and 70, you might be able to deduct up to $4,350 from your long-term care premium. Now, obviously, if your premium was only $4,000 and you're self-employed, you could only deduct $4,000. Also, if you're self-employed and you really don't file taxes being self-employed, then you can't do it. So you have to show that you're self-employed. Is there any questions about the financing here? No. Okay. We are moving along. Okay. I actually believe this might be my last slide. Options for the insurance in general, and then I'm sure you'll have questions after this. So the way that policies are set up is you have a monthly benefit. Usually when I'm talking to people, we're looking in the $6,000 to $12,000 a month of benefits. However, some people have less and some have more. and how long the benefits will last for. So that's called the lifetime benefits. It's really a dollar amount, but it's usually roughly equal to between 2 and 6 years, or possibly lifetime if you have that particular hybrid plan. Okay. Then there's the elimination period, which again I mentioned is the waiting period. And most plans, actually that's a typo, it should be 0 to 365, but most plans have a elimination period of 30 to 90 days. And with some of them, you can waive it for home care. So that's where the 0 comes in. So you could have a plan that it's 90 days that you have to pay out of pocket before your benefits start if you're in a facility, but that gets waived for home care. And that can be a very nice feature. And then depending on your age, the amount of benefits in your own personal profile of really how long, how much money you need from the insurance. Do you want to have inflation protection built in or not? So I'm showing you here, plans usually have 0 to 5% inflation protection in. An average these days is 3%. A lot of people will take plans if they're in their 60s or younger that provides 3% compound inflation. What does that mean? It means that your monthly benefit and your lifetime benefit are increasing each year by 3% compounded. It does not mean your premium is increasing each year, just your benefits are increasing each year. Some people choose to not have inflation protection, knowing that there's going to be inflation, but they choose to do that by taking out a higher monthly benefit to begin with, and just knowing that as they age and go down the road, their portfolio hopefully is growing as well and supplements more. Now, one other thing I want to tell you is that most people, all people who take out long-term care insurance, they're not expecting the long-term care insurance to cover 100% of every possibility for long-term care. It's usually co-insurance. So you'll have a long-term care insurance and maybe it gives you $10,000 a month, but it's going to cost you $18,000 a month and you can comfortably cover $8,000 of it or something like that. So the basic example down here, let me show you how a plan would be set up. So in this example, the monthly benefit is $8,000 and the lifetime benefit is $192,000. That means that the most that you could be reimbursed for care would be $8,000 a month. Now, if the cost of your care is, so we're in this part right here, if the cost of your care is $9,000 a month, you're still only going to be reimbursed $8,000 a month. If the cost of your care is $7,000 a month, you're only going to get $7,000 a month in reimbursement. So just $8,000 is the most they'll reimburse you, but no more than the actual cost of care. In this example, I just had a lifetime benefit of $192,000. So that means that once you have spent $192,000 worth of this plan, your plan is finished, you don't have coverage anymore. If you were to spend the full monthly benefit of $8,000 each and every month, this lifetime benefit would be depleted in 2 years. So some people would call this a 2-year plan. But you just have to understand, if you spend less than $8,000 a month, it will last you longer than 2 years, okay? And if you add inflation to it, to give you an idea, if you took out a plan now, the same plan in 10 years, your monthly benefit would have grown to $10,438 and your lifetime benefit to over $250,000. In 20 years, that goes up again to over $14,000 a month and over $336,000 lifetime benefit. Some people have asked me, if I take a plan now and I don't feel it's enough, can I increase it later? You really can't, because the later is going to be based on your new age, your new health, the new rates, and it's probably unlikely that you'll want to do that. So you try to get the plan that you want. However, in the future, if you want to reduce benefits, you can reduce benefits, but not to below whatever their bottom line is. But you can reduce benefits. So in this example, you could reduce benefits. Let's say the minimal was $6,000 a month that your plan could offer. You could reduce that $8,000 as far as $6,000, and then the lifetime benefit would also be reduced by whatever that percentage would be. In this case, it would be 25% reduction. Okay. Does anyone have any questions about this? Yay. Okay. I can't unmute you though. Drat. I don't think I can. Ah, there you go.
I have a question.
Yes. I hear you.
Okay, this is Brent. Is there a cutoff age for buying life-term insurance?
Great question. Different policies have different cutoff ages. Normally around 78, 79 maybe is usually a cutoff. With some of a life insurance plan, you might get a little bit older than that. I think I've even seen one that was 81. Annuities might be even more. Annuities, by the way, the annuity long-term care plan is the easiest plan to get based on health as well. The underwriting is a lot less.
Oh, okay.
By the way, if anybody wants to ask me a question, doesn't want, to ask it in a public forum, this is my information and I encourage you to take it down. You can call me, you can email me. I don't charge anything. I'll answer every single question that you have. If you want to know what it will cost you personally, or, if there's someone you're on the call for to find out about them, I'm happy to do that. So please do take this information down. And I think this will also come to you in the email as well. But I'm happy, Brent, if you want to reach out to me by email or by phone and let me know your age. I can respond with real ideas for you, okay? So there's a couple of other resources that I do want you to know about. This is one of the links, one of the websites I wanted you to have. And at the top, you can see the URL at seniorly.com. So senior with an ly.com. Seniorly.com up here. So SENIORLY.com. This is a website. It's an organization that helps people who are looking for places to move to, senior living facilities. And this front page here, it just shows you the kind of things that they offer. So there's independent living where you don't need long-term care, assisted living where you do. Usually an independent living does both. Memory care, when you're, it's a specific facility just for memory care, which it can be great because for those kinds of facilities, they don't lock the doors and there's places to wander. The board and care, the small places I was telling you about, and then the CCRC are the continuing care retirement communities or life plans that I mentioned to you. And then they have other resources. So I do highly recommend them if you or a loved one is looking for your next home, and they do not charge you if you work with them and you get placed in a place that you like and you want to stay there, the facility pays them. So there's no charge for you. I'm ready for those questions. After my higher premium since 2000 to have an unlimited time policy, how can Genworth justify forcing me into a 4-year plan? Well, forcing you. They're forcing you because you don't want to pay the higher premiums. That's how they're forcing you. Why are they doing this? Because if they don't raise rates, the company will go under. If the company goes under, all the other insurance companies in the area have to back them up. Even companies like, like let's say Kaiser or Blue Cross, who don't even offer long-term care insurance, because they're all like part of this insurance brokerage where they have to like back each other up and they don't want to go broke. Genworth, and I have worked a lot with Genworth. Genworth was the leader in the industry. It was always the leader in the industry. It still has the best claims department that's out there. It's got more experience than anybody else. But because they had so many policyholders, like more probably than all the other companies combined, they took on a huge amount of risks. They offered unlimited plans. They did minimal underwriting. The rates were very low, and they had 5% compound inflation for most people. If you fast forward 20 plus years, the actuarials in the industry got it wrong. They weren't charging enough. So plans today are much higher than they were at the time that Genworth, was doing this. Oh, and you said after whoever wrote this, I'm not sure if you took it out in 2000 or you were given higher premiums in 2000. Okay, Kathy. So I'm not 100% sure, but you should have received a letter from them giving you options as to how to, options that you have. And what I didn't like about the letters they sent out to their policyholders with the option was it was in very small print that you have other options, but it was a lot of people didn't see it. And so they just chose from the options that were on that sheet. And one of the options was to keep your plan the way it is, but take the rate increase. And another option might have been for 4 years. If this answer is not enough of an answer for you, reach out to me one-on-one and I'll go through it in a lot more detail for you. Going on to question number 2. If you have long-term care insurance and you move into continuing care facility, like the Sequoia, is long-term care insurance accepted? Yes, I can't speak for every facility. I believe it is for the Sequoias. Is the Sequoia the one I was talking about that's near Japan Center? If it is, I know for a fact, yes, it does take it. But that was the facility whereby if you need assisted living, they don't cover it in your unit, in your apartment. You have to go to a separate wing. A lot of people don't like that, so they keep their insurance for that. So if you move to a continuing care facility, you want to find out from them before you sign on the dotted line. A, do you take long-term care insurance? B, would you make me have to go to a wing if I needed assisted living care? Then you can decide if you would keep your insurance when you go in there or you wouldn't. But let's say that you kept your insurance. The insurance isn't going to pay the monthly fee at the Sequoias until you start to need care. So remember, the Sequoias is the life care facility and you're healthy when you move into it, but you still have a monthly fee. So the insurance would have nothing to do with that. You would not get started to be reimbursed for care until you actually started receiving that care at the Sequoias. And yes, it should cover that, but you want to double check that it would work with the Sequoias. Again, reach out to me if you need more information. Number 3, my husband has dementia and we have long-term care now for 20 years. Okay. Okay, so I don't know what the question is, but if your husband has dementia and you have long-term care insurance, file a claim. Just file a claim. There's no reason for you to wait. If you don't understand how to do that, reach out to me. But basically, you're going to be calling the claims department of your insurance company. It should be on your policy, the claims department. If it's not, and you just see customer service, that's all you can find. You call customer service at your insurance company and you ask them, what is the phone number for the claims department? You want to file a claim, don't wait. There's no reason to wait. The only reason would be if you want to take care of your husband yourself and you're hoping you're going to be reimbursed for it. That's not going to happen. So file a claim, and at the very least, and this happens to me a lot with my policyholders, they don't want to file a claim. Oftentimes the wife feels guilty. She's not taking care of the husband. And I say, file a claim, get it approved, and then give yourself a break. Even one day a week, have somebody come in and you've got the insurance for it. So that is my answer there. There is no reason to wait if he's diagnosis of dementia. You're waiting for nothing. And in most of these policies, not all, but with most of them, once a person starts to receive the benefits, they don't pay the premiums anymore. So it's another reason to file a claim. Number 4, are costs escalating? If so, how much and what about the future? It used to be that the costs were escalating pretty high. I would say 3 to 10% a year. They've come down a bit, but we're in this like no interest economy right now. So no inflation economy, I should say. I anticipate that they will start to jump up a lot more in the future. But right now, I think probably 3 to 5% in a lot of cases is what you're looking at in terms of how much the costs of care are going up annually. So one thing that I would ask you to do on that is, because I don't have a crystal ball, but one of the things that you could do is if you're thinking about care, you could, and you're thinking about where I want to receive care and how will the costs go up, you could check with either an agency for home care or a assisted living facility or a continuing care retirement community and just ask them, can you tell me, I'm thinking about, using you, can you tell me how much your rates have grown, say, over the last 5 years? And they'll tell you that information. You have to pretend that you're really thinking about moving in there, but it's so much across the board. I've seen some places where it's gone up minimally and some places where it's gone up more. So let's see. COVID, safety, and assisted living. That's a big issue. I had another client who swore up and down that she was never going to, she was different than my dad. She only wanted to go to an assisted living. She was never going to stay home. That would be terrible to stay home. I want to go to assisted living. I want to be social. And now she took out a plan that was a facility only plan. And what happened was that she told me she needs care and she wants care to come into her home, but she's wait, hold on a second. I'm getting confused. I apologize. It was the opposite of that. She had a home care only plan. She wanted to go, no, she had a facility plan. She didn't want to go to a facility. She wanted care at home. She didn't have care at home. Got it. Sorry, my mind is a little bit weak right now. She was scared to death about going into a facility. Her plan only covered her for a facility. I told her she didn't have home care because that was what she chose. She was very upset. So I can tell you from personal experience, if you had a plan that didn't cover home care, you're very upset because you don't want to go into a facility because yes, there's issues with COVID. That doesn't have anything to do with the insurance company per se, but it does have to do with long-term care, and it is a huge issue. So if you have long-term care insurance or someone you love does, try and keep them home. That's going to be the best way to do it, but it's not foolproof either. So yes, so COVID, safety, and assisted living, it's challenging. And if you have a loved one who's in an assisted living facility, it's nothing like being a squeaky wheel. and going there and popping in at all different times or calling them and finding out how they're handling the issue. You need to put pressure on the individual places. And one of the things that I've actually heard about some of these assisted living places or home care in general is that people have more than one job. And so that's how some of it is transferring. So they might be in one place and then they go to another place. It's really challenging right now. Are long-term care insurance policies workable at Sequoias or SF Towers? That I answered that question, I believe, before, but I think everyone was just sending them in at the same time. Let's see. What is the age you would recommend buying for long-term care insurance? Well, you're not going to like this, but the age that most people are taking it out right now would be 45 to 65. And right in there, the 50s is the sweet spot. And the reason why is the prices are lower the younger you are, although they can go up on the traditional plans, but it's easier to get based on health. If I have a 55-year-old who's in bad health and a 78-year-old who's in great health, the 78-year-old still might be able to get a plan. It'll be expensive, but the 55-year-old can't even get a plan at all. So you can only base it on where you are now. If this is the first time you're looking at long-term care insurance, you can't go backwards on it. But if you're beyond a point of thinking you can get it, you know, you might want to encourage the next generation down to think about it at a younger age or at a healthier age, because you really do have to be pretty healthy to get it. And if I can discuss health with you, let's say that you actively have cancer today, you would not be able to apply for any type of long-term care insurance. But let's say that you had cancer 5 years ago and it was stage 1 or stage 2, maybe it was breast cancer, prostate cancer, or something like that. As long as it's taken care of and your PSA is normal and, all of that, then you probably can get the coverage. You may not get the most preferred rate, but you can probably get the coverage. So they look at an individual situation like cancer, like anything, any health issue whatsoever. But they also look at your combination of health issues. So you might be someone who has high blood pressure and you're also a diabetic and you also have asthma. Well, that might be too much for them, but any one of those maybe by themselves under control would be okay. So those are the reasons why you do want to get it as young as possible. I think that's it on the questions. Again, do not hesitate to reach out to me. Whatever you say to me, tell me is confidential. I'm happy to answer your questions. And this is really, really a personal issue. So every single one of you on this call would approach it in a completely different manner. And I can certainly get you actual rates. No one has asked the question, and I know you're all thinking it, what does this cost? So I'm going to tell you, long-term care insurance can range anywhere today, these days, from maybe $3,000, $4,000 a year up to add a $10,000 onto that, maybe $14,000 a year, depending on what it is that you're getting, your age and your health. Is it a traditional? Is it a hybrid? What's the monthly amount? What's the maximum amount? What's the deductible? Is there a death benefit? All of that. So it's a huge range, but I'm happy to tell you what it would cost you. Okay.
Hi, I have a question.
Yeah.
So, no, I don't. Actually, we went through this whole process with my mother-in-law, so you have a lot of really great information. But I have a question just for kidney patients who are like me. I'm healthy now, but I do have a kidney transplant from a living donor, and so a kidney may last, I don't know, 15 years or for the rest of my life. I don't know. How does that factor in, considering Medicare will pay for my dialysis and so forth?
Transplants are usually a no-go.
Yeah, that's what I thought.
I don't know if the one thing I could check on for you and get back to you if you want me to, but you would have to reach out to me because I don't have access to you, is if the hybrid with the annuity / long-term care would consider a transplant. So if you want to reach out to me and just tell me your age and when the transplant was and the medication that you take for it now, or what you do for it now, I can get back to you on it.
Okay, thank you.
Thank you very much for the presentation. It was wonderful. And though I don't have any questions today, I look forward to getting those contact points. I'm going to email you or phone you. I've got a couple of questions I'd like to take off air.
Absolutely. I love doing this. You know, the first experience that I had with long-term care, I grew up in Los Altos. I am a local. And when I was a child, I was riding my bike down University Avenue and the orchards in Los Altos. And I saw this old man shuffling down the middle of University Avenue in a dark suit and slippers. And I never seen him. I had no idea who he was. And when I kind of slowed down going past him, he looked at me in the eyes and he said, "Do you know who I am? Do you know where I live?" And it just completely floored me and freaked me out. I mean, I still have that memory vivid in my head. So I like helping people when I can. I couldn't help him at all. I probably went home crying. I had no clue. But, you know, that was my first exposure to someone who was cognitively impaired. And then both my grandfathers ended up being cognitively impaired.
Yeah, I want to add something.
Yeah.
I took care of my mom and dad before they died when they were in skilled nursing. Spent a lot of time with them, and people said, "Well, why do you do it?" And I said, "Practicing for later."
Yep, that's what happens.
We're all going there.
Yeah. I have another funny story about one of my grandfathers. So he was a builder in San Francisco. He actually got the contract to build the War Memorial building. And so we're talking about a really long time ago. And he poured the cement and it sunk in because there's a river under there or a stream or whatever. And he wanted to finish his job. So he poured the cement again, and it stuck. But then he went broke because he had lost everything from that job or from the depression. But when he became senile, he was living down the peninsula, and his wife had put him into a nice little place near them on Sand Hill Road. And he disappeared from Sand Hill Road. And his brother, who was still working in the office in San Francisco, said, "He took a bus and he's here." So you got to watch those people when they don't quite know what's going on. They still have their routine.
Thank you so much for that wonderful and interactive presentation.
Thanks for giving me the opportunity.
Of course, of course.
Thank you both very much. Thank you both very much.
I appreciate it. All I have to say is go forth and prosper and wear your mask. And try not to be too freaked out. But when you look outside.